Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, my guest is Eric Mason. Eric is the CFO of Quincy, Massachusetts, his local town, which is just south of Boston. And I asked him to come on the show because he's been a practicing economist for quite a while at this point. We talk about a lot of economics and investing concepts in general here on the show, but it's been a while since we've had an actual economist on to talk through some of these issues. Someone who's practiced in the field for a long time and uses that background to make day-to-day decisions in a really vitally important role for his local town. So Eric joins us to talk about his take on where the economy is. There's a lot of pessimism around the country related to where we're heading as an economy. There's this concept of whether the Federal Reserve was able to thread the needle between taming inflation and driving us into a recession. And Eric joins us to share his take on the numbers, his perspective, what he expects to happen in the economy here over the next 12 to 24 months, and his take on federal debt. We have a large amount of national debt that a lot of people are growing concerned about. Eric shares his perspective when he looks over the numbers and how our economic system is set up, both here in the U.S. and abroad. It was a really good conversation. Eric's a lot of fun to talk to. He really knows his stuff, and I hope you enjoy the discussion too. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Eric, welcome to the show. You had a lot of kind words to say about the show here just a moment ago when we were chit-chatting. They were very flattering, and so I like you already. But more importantly than that, you're a labor economist. You're the CFO for a local town in Massachusetts. You live, speak, eat, breathe economics that informs a lot of what we do as investors. And I'm really happy to talk to you about some of the stuff that I can kind of speculate about. And I'm really curious what your perspective is on national, international economy. And I just have a ton of questions I'd love to pester you with today. Why don't we start with this? Could you give us a little bit about your background, what your role is today, how you got into it, just to kind of set the tone?
Yeah, absolutely. So I'll start with my educational background. So I have both my bachelor's and master's degree in economics from the University of West Virginia. I was very fortunate to have a great college experience. I had some great mentors in the economic field. I was fortunate enough to publish when I was an undergrad. So I've always enjoyed the academics of economics. Sometimes I think the academic of economics gets in the way of making it consumable to investors. And I think that's one of the biggest crimes in economics. Professionally, I've worked in the public sector for about 10 years now, spending about the last 4 years as the chief financial officer for the city of Quincy, Massachusetts. If you have some history buffs, well, Grant could probably see it. I have a cemetery outside my office window. That's one of the oldest English-speaking cemeteries in the country. I share
very nice.
I share a courtyard where John Quincy Adams are buried. So it's a very historic city. And I grew up here, so I love being able to work for my fellow Quinceyites. But prior to being the CFO, I was the chief analyst and economist for the city. I oversee about a $400 million general budget, and I do about $500 million in expenditures, as well as the city of Quincy has a $1 billion retirement fund. I should say pension system that my team, under the guidance of Mayor Koch, we issued the largest pension obligation bond in state history, and I believe it's like one of the largest in the nation's history to fully fund it. Basically, when all those rates were 2.6%, we went into the market, scooped it up, and we were able to invest that in our pension fund, and it's now receiving returns a lot higher than 2.62%. It is kind of crazy. We pay 2.62% on that debt, and we can get treasuries for 5.5% now. That really stabilizes that pension fund over time.
That's what we call a good trade, my friend. That is a good trade.
It's arbitrage, right?
Yep.
So yeah, it's we have I've had some, I always say my resume reads a lot older than I probably am. I've been fortunate enough to do a TED talk on the importance of local government, spoken at the World Finance Forum, and a few other times I've been able to kind of ramble about economics when good people like Grant let me.
You're in a very impressive position, and I'm also really impressed that you published as an undergrad economics student, because I'll tell you, my bachelor's is in economics as well.
Awesome.
And I didn't have anything close to worth publishing at that point in my life. So that's a pretty impressive feat.
No, I mean, it was a team effort. I mean, it was I was very fortunate. The way I always look at it is that your mentors make up a lot of what your career success is going to be, and I am very fortunate and was very fortunate to have a strong mentor that really kind of pushed me to go for that, and he published with me, and I'm sure he has more gray hair today because of that, but it definitely helped me.
So tell us about your perspective on the national economy right now. And just to kind of set the tone for this, unemployment's at about 3.7% last time I checked. Q3 GDP growth was about 4.9%, which is really good. We don't have the Q4 numbers out yet. Interest rates seem to have maybe plateaued for a little bit. The Fed has forecast that they're going to slow down their cuts, or slow down their hikes, maybe even start cutting later this year. How do you see things as they stand now? And the other component of that is it seems like a lot of people I talk to are just really pessimistic in general, even though the numbers are looking pretty strong. So how do you see it? What are you thinking?
Well, I'm jealous of the pessimistic people, to be honest with you. Because they have an easier story than I do. I'm optimistic. I'm very optimistic. And I was giving a keynote about a month ago, and I was up there, and I was like, the first thing I led with was, it's okay to be optimistic. It's okay to accept these are good numbers, because there's been a charade going on right now. I mean, there's been people calling for a recession since quarter one of 2021, and I continuously hear these calls for it. There's going to be a recession. There's going to be a recession. It's been 12 quarters. And it hasn't occurred yet. And I asked myself, okay, if you're going to eventually say there's going to be a recession, great. There will be one. What makes capital markets alive is they go up and down. So, of course, there's going to be a falling action at some point. But if you say, hey, look, I called this 12 quarters ago, you're not some great soothsayer. You're just saying, hey, eventually you get in a plane and say, eventually it's going to land. Well, of course it is. It's going to run out of gas. But people struggle to point. I always ask this question, and the struggle to point out a difficult metric. Point out the metric that causes recessions, not negative metrics. I'm not talking about like, oh, there's a stock doing this and earnings are overstated and stuff like that. That's different. The stock market's not the economy. It's important to it, but it's not the economy. And when I look at these macroeconomic indicators, they look very positive. We have more. What grows economies is capital. And the amount of direct capital investment we're seeing right now is far outpacing depreciation. And so the Solow growth model, Dr. Solow wrote Nobel Prize winning model, is the reason that we have, it's how we measure economic growth, or how we predict economic growth. It says if you have more capital accumulating in the economy than it's depreciating, you are in a growth period. And you then couple that with there being 4 million more jobs open today than there was at the beginning of the pandemic. And combine that with low unemployment, like you gotta show it's broken to me. You can, and again, like I said, I'm jealous. It's easy to write the doom and gloom article. It's easy to go out there and say the world's falling. I always say we're pessimistic apes. All humans are the same. We're scared apes, and we want it to be doom and gloom. We want it to be. And I have to start these presentations. And I was on another show about a week ago, and I said to the gentleman hosting it, I said, it's okay for it to be good. It's okay to be okay. And people don't want to hear that. And listen, it's not 100% rosy picture. I know we're going to get into a conversation about national debt and interest rates and refinances of debt. There's stuff people need to strategize around, Grant. And that's where your expertise comes in. And there's a real need for people like you who can take these macroeconomic indicators that are word soup and vomited out by people like me and actually build a strategy. But that board you're going to play on over the next, let's say, 4 quarters, 6 quarters, I don't see a bump. I don't see a disaster sitting there. If unemployment was higher, if GDP growth was slower, if banks had less holdings, if ALL was rapidly depreciating, it's not. The fundamentals are there. This is a Tim Duncan situation. It's all about the fundamentals. Yeah, I'm rosy. And shit. I mean, I'm sure somebody will clip this and throw it back in my face at some point. But if you've been calling for a recession for 3 years and it hasn't occurred yet, you're not any sort of great economic or financial mind. You just know markets go up and down. It's like the guy who, I'm not buying a house. I'm waiting for houses to crash, and houses were $400,000. They go up to 900,000, crash down to 7. The guy goes, "See, I was smart. I waited for it to crash. I'm brilliant." It's like, no.
Yeah.
Maybe that makes you feel better when you're paying a higher interest rate and higher price, but you're not Buffett.
You said a couple really important things there. One of them is that the economy is not the stock market, and the stock market is not the economy. The economy, I have a lot more confidence in people like you giving some forecasts and predictions, because the fundamentals directly lead to whatever numbers that we see 12 months from now, right? The stock market is based on a whole bunch of humans buying and selling intangible securities, based on debt, based on profitability, based on all these things. And we're just such stupid apes. Were those your words? I'm trying to parrot. Right? We just make really dumb decisions, and everybody has a different time horizon, a different investment objective. It's easy to think that, like, people like you and me are putting a little bit of money away for our own retirement, and we're investing it in some target date fund, and everybody else in the world is doing that. Well, guess what? People like us are doing that, but there are endowment funds and pension funds like yours and sovereign wealth. There's a whole bunch of money from around the world with totally different risk return needs than we have, and they have different reasons to make different decisions than we do based on the same information. So there's a huge amount of irrationality in there, and it is impossible to predict what's going to happen in stocks over the short term. Over the long term, they tend to return toward their fundamentals. So that's one thing that I really wanted to highlight to our listeners is the economy is not the stock market. The stock market is not the economy. And I was focusing on that point, and my second point has just lapsed, and Grant, I'm trying to remember what it was.
Well, you're doing what I do a lot, which is jog the memory. You said a great thing that I want to throw out here. You said based on the same information. Economics has all these pillars, and one of the best pillars, and I use it in economic analysis, I use it even in management, is people behave rationally given the information they know. So if I'm having a management dispute, like I always say, well, before we start arguing, is there asymmetrical information here? Does somebody know something I don't know, and vice versa? Because if we're all rational apes, eventually we should come to the same decision. And I think what people like you do, Grant, I think is very, very important for the overall health of the economy, but also just for your client base, is they have more information. You have a better understanding of the market, especially on the stock market, than I do. I'll just be like, you do. You absolutely, you live, you breathe this, you know it better than me. I can talk about, big, large macroeconomic swings, and we can have a wicked fun discussion on interest rates and on national debt, but you're going to consolidate information. And that's where a lot of people who benefit from being more involved in the market is having better information than people around them. And that's really, in the short term, it's not about being a great stock picker. It's actually just knowing the market better. It's just understanding these fundamentals better, but also understanding that, hey, it's a bunch of apes throwing bananas at each other, except they're pieces of paper and we wear pants. I mean, that's really what the stock market is.
Right. And I'm trying to think back to my own economics education. When you go through an economics program in college or grad school or whatever, you learn all these models and these fundamental and these really important concepts. But the caveat is ceteris paribus, which means all things equal, right? Meaning all market practitioners have the same information and act rationally all the time, which is
they don't.
That's not even close to reality. I mean, no doubt, helpful concepts to understand, but those are two very different things. Thank you for jogging my memory, by the way. The second thing I wanted to point out there was we see this concept of people making economic or market forecasts all the time. And then when stuff finally does go down for a reason totally unrelated to their original hypothesis, they claim that as a win. And from people, financial practitioners, whether it's Jim Cramer on CNBC or an advisor that has a radio show that you listen to locally or whatever it is so seductive from a marketing perspective to make these bombastic calls because it grabs people's attention, and this is the world we live in today. It gets more clicks and more eyeballs to your stuff when you make these predictions. You could make a dozen of them. You could be wrong 11 times out of 12, but the one that you got right, you can focus on, and people are attracted to that. It's an interesting thing that I think everybody needs to be aware of.
Yeah, it is one of the biggest issues I think we deal with as economists. Like, one of the examples I always give is that there are 22,000, 24,000 economists in the United States, about that. There's 330 million opinions on economics. There's 330 million people in the country. And you can win a Nobel Prize in economics. And I gave an example one time. I was talking to somebody, and I said, if I walk over to that person and I say, trickle-down economics does not exist, there's a good chance he's going to get angry at me. There's a good chance. If I walked over to that same person and I said, salt's ionically bonded, he'd be like, okay. Well, both those things are factual statements. Salt's ionically bonded. Sodium chloride's ionically bonded. And trickle-down economics does not work. It does work. It works in like North Korea. And that's because capital flows to its most efficient place of return. That's good, solid, fundamental capitalism. But people get emotional. They get tied to their economic opinion. They view, like, one of the best things, the easiest person to change their opinion on economics is an economist. And I tell my students when I teach, I tell them, I go, one of my favorite things to do is it's a remote class. I'll say, all right, how many here have an opinion on economics? And you'll get some kids who raise their hands. You get kids respond to email, I do. All right, how many of you have taken a course in economics? Nobody has. Like, okay, congratulations. Your economic opinion is swayed by emotions, history classes, and your political leaning. Economics doesn't care about any of that. And that's where people get kind of, I think that's where people really extend their careers in certain ways by propagating fear and propagating non-reliance on fundamentals. Like, economics is boring. It's beautiful. It's the dismal science. It's people like me who love it. It's beautiful because it is boring. There are certain things that move. There are certain assurances in the data that aren't fun to talk about because they're not interesting. And one of the reasons that I've really like bringing the informality of economics to people is because I'm a true Austrian. I do really believe in Austrian economics. And as Hayek said, the man on the spot, the person buying a car, the person buying groceries, the person pumping gas into their car, making that buying decision, knows more than every economist in the world combined about their personal economy. And when you sum all those personal economies, you get the economy. And I think there's some beautiful symmetry to how the stock market works in that what people's decisions they're making, what stocks they're choosing to buy, isn't always this perfectly rational model that people like me would love it to be. And I think that's why people like you, Grant, who have to deal with that, can certainly lead to some more interesting situations than I do, searching the Federal Reserve Economic Database for, a new line that's slightly different than an old line.
So explain, could you compare the Austrian School of Economics to other schools that another economist in your seat might ascribe to?
Yeah, I mean, I'm not the purest of pure Austrians because I do believe in econometrics, and Austrianism came about long before we could build economics. I know how to code in a couple different languages. I do certainly believe in mathematical approaches. It's heterodox. It's really, I don't want to call it a rejection of Keynesianism, which in recent years, I find myself defending Keynesians more than ever, because a lot of people accuse Keynesian policies of being socialist policies, and I'm like, they're not. I mean, one's just more government intervention, so it's not socialism.
So explain what all those things, heterodoxy, Keynesian, explain all these for us.
So macroeconomics is actually a really young field. I was in front of the city council one time, and we had a counselor say to me, she goes, well, there should be models about this. And I go, well, when this was during the pandemic, and I said, well, counsel, with all due respect, macroeconomics didn't exist when the last pandemic occurred. The Spanish flu was 1918. John Keynes didn't really found macroeconomics until the late 1920s, early 1930s. So what Austrianism really believes in, heterodox, is basically saying you have the orthodox school of macroeconomics, which was Keynesian. We now call that Keynesian years later, but the guy didn't find, John Maynard Keynes didn't found the field and call after himself. That school of people years later developed it. A competing school, which was founded by actually one of Keynes's friends, Friedrich Hayek, and a few other people. I'm going to say Friedrich Hayek. There's a long list of other great economists who built up this field. is Austrianism. Austrianism, Keynesian focus more on the state being involved in how the economy moves. I am part of the state. I am a government worker. I'm not railing against that. Austrianism focuses more on efficient information transfer via price. So when I say I'm an Austrian, what that really means is I don't like price manipulation. I don't like subsidization. I don't like disproportionate taxation. To me, a good, efficient economy translates information through prices. Things that are more expensive for a reason. Things that are cheaper, particularly for this one, things that are cheaper for a reason, not because of government subsidization. But what made me fall in love with Austrianism is not a lot of the stuff people will read in the paper, or a lot of times when people give this a Google and read the Wikipedia, because there's parts of Austrianism I disagree with. It's the man on the spot. That is a concept from Hayek, where we need to empower people to make good decisions, but that doesn't mean restraining the decisions they have to make. It means it allows people to play in the market, and that if you give people resources and say, hey, you go spend them on what optimizes your utility or your happiness, we're going to get better outcomes than the state kind of blindly guessing what people are going to need. So Austrianism really focuses on empowering the individual while keeping prices very transparent and clear. It also stresses interest rates. Interest rates are everything to Austrians. Like, they express risk, they express time value of return, they express general optimism or pessimism in the market. Where Keynesian is more of a state-centric viewpoint. It's not socialism. Socialism, I always tell people this, socialism, does the government own the means of production? No, it's not socialism. Just because somebody wants to increase welfare or somebody wants to have higher taxation, they are not a socialist. They are not. They're a capitalist. They just believe in different government policies. Norway, Finland, Sweden are not socialist nations. They're capitalistic nations, right? It's an old joke on the internet. If you don't like somebody, they're either socialist or a fascist, where we're not allowed to have opinions anymore. So yeah, that's really kind of breaking down those three categorizations.
So the reason I asked about that specifically is where policymakers fall on this spectrum really informs how they tend to make policy, right? So if you're like let's say the National Treasury Secretary, and you don't like where economic growth is, we're not growing as fast as we could. A Keynesian would say, well, that means that the U.S. government needs to spend more money because we're sending more money into the system. Small businesses will have it available. That'll slosh. That'll be better for everybody. It'll stimulate the economy. An Austrian would say, well, we need to take more monetary stimulus and reduce interest rates to make things make money cheaper to borrow, right? And you can see how this plays out in our federal government and where people sit on this spectrum who are in positions of power. I think is a really important distinction to understand what's actually going on. Was that an appropriate paraphrase?
That was absolutely fantastic, Grant. That's exactly what's happening. And
okay.
But what's important, I just want to point something out. And I gave my TED talk on political division. So this is something I just want, and I don't like discussing national politics. But I want to point something out. The Keynesian is trying to do what's best for what he thinks or he or she thinks is best for the American people. And the Austrian is also trying to do what he thinks is best for the American people. And I think that's an important thing. I don't like the concept that just because somebody has a different economic philosophy than mine, it's inherently evil. I think there are bad actors, don't get me wrong, but I think sometimes we equate policy to person. And I think that's not always the healthiest way to move.
Yeah. Yeah, because my take on this has always been that because economics is a social science, and as you put it, if you're in chemistry class, you get 2 hydrogens and 1 oxygen, you get water every time, no matter what, right? Economics is not that. It is the exact opposite of that. And so for that reason, politics has kind of infiltrated economic schools of thought and thinking and decision making, right, and policy, which is why someone more Keynesian would probably fall on the left side of the political spectrum. An Austrian would probably fall somewhere on the right. People are more complex than that, obviously, but that's generally where our two political parties fall, which is an interesting and kind of an unfortunate thing that we have to oftentimes, ideologically fall in line with whatever party we tend to vote for.
Yeah, I'm so, with my school being an Austrian and growing up in one of the most liberal areas of the country. I'm a unicorn. People have no idea where my political leaning is. And then I went to school in the South. People up north think I'm very conservative. People down south think I'm very liberal.
West Virginia is considered the South, I guess, south from you.
Yeah, South. My friends, we always get in this argument. South of Mason-Dixon line, I'm calling you the South.
Okay, fair enough. Fair enough.
I have a geography minor. I'm not smart enough like that. To me, and I think most economists we're not extremists. We actually hate extremities because it's the extremities, they're wrong economically. They've never worked. They've never led to anything productive. And just to be blunt, we view it all the same. We actually don't even have a term. Like, communism is not an economic system. I always love that question. When are we going to learn about communism in class? We don't. It was written by some guy who used to sell his pants at a pawn shop and was funded by a aristocrat and Friedrich Engels' father. Like, it's not. Fascism is not an economic system. There are three economic systems. There's capitalism, there's market socialism, and there's centrally planned economies. Especially in this politically charged environment, when you tell somebody that communism, fascism, any authoritarianism is one form of economics, it's centrally planned economies, they get angry. It's like everybody wants to think their product's unique, but all extremists are the same. They're not looking at the numbers. They're not looking for a rational discussion of economic data. And I think sometimes you brought up a great point, Grant. Sometimes by us categorizing people falling into the Keynesian or falling into the Austrian school, we inadvertently categorize people when people are more complicated. There's probably a lot of people who call themselves Austrian who love certain policies, who love Keynesian policies. I know I do.
Is there any historical support for centrally planned government? And the way that I think about this is there are a whole lot of ways that any government can allocate resources for the benefit of their own citizens and their own economy toward the agenda of the country, right? And we're obviously a more capitalistic society. But when you look back historically, communism, socialism, anything that falls into the centrally planned government category, is there any historical support for that from an economics perspective?
No, not really. Like, unfortunately, obviously as an economist, I look at everything through economic minds. There's a field of economics called cliometrics that takes economics and applies it to the past. No. The Soviet Union gave it a damn hell of a try. China, up until the 2000s, gave it a damn hell of a try. The beauty of capitalism is it has the ability to implicitly express demand before demand is explicitly expressed. You will not get a car in a centrally planned economy. You'd get faster horses, and that's really the beauty of capitalism. Capitalism, some people say, may have its flaws. I would say you start with capitalism and then flaws occur afterwards when it collides with policy. I always say politics is an unwilling partner of economics, not vice versa. You can try and make as many political decisions to ignore economics, and it will work for a long time, the Soviet Union, and then it will fail. And unfortunately, we're watching that right now in China. We are watching towers being empty housing towers being demoed. We're seeing over-reported population growth. We're seeing the vast majority of homes being second or third market selection homes. We're seeing it. Oh, China poured more concrete than all the U.S. in the 1900s. That's great, but just pouring concrete does not grow your GDP. Short term, it does. Government expenditures grow GDP, but GDP is made up of three components: government expenditures, consumption, investment, net exports. Only one of those, which is investment, actually grows your economy in the long run. So as much as central planned economies really stress that G, that government expenditures, and it's not sustainable, because as somebody who I collect $300 million in tax revenue a year. Small compared to the grand scheme of things, but probably more than the average bear you talk to at a bar. And it blows my mind when I tell people that $300 million, I don't want to collect any more than I need or any less than I need, because that one extra dollar floating out in the economy that wasn't taxation is going to be more productive than if it's held in a coffer. Government's very good at certain things. At public goods, it's very, very good at defense. I mean, you can't privatize defense. It's good at infrastructure. Everybody complains about infrastructure, but the market return rate for infrastructure is less than 2%. The private sector is not going to build infrastructure. That's government's job. Level the playing field. That's our job. When money's spent, government expends money leveling the playing field. It's great. But you can only make something so level. Like just can't keep spending to leveling the playing field. So no, it hasn't worked. The closest thing we've ever had to kind of like a centrally planned economy working was mercantilism in Italy. You think of like the Medici family.
Mm-hmm.
How centrally planned that type of economy is up for grabs. It's kind of like, hey, keep exploring, gathering more money and support an artisan class. Don't know if you'd call that centrally planned economy, but I also don't want to discount anybody who'd be like, well, actually, mercantilism was pretty centrally planned. But even that relied on trade, which trade's capitalistic. I don't care what anybody, trade is a capitalistic thing. It just is.
Right. I've always seen this as very, very, not quite identical, but very, very similar to the argument for index investing in general. Because time and time again, and our meaning the United States prominence on the global scene right now is a direct result of us, winning World War II, but then also using capitalistic forces for our benefit. And when you have a capitalistic system, there is this meritocracy where supply and demand and the markets sort it out. And it is by far the most beautiful, efficient way for goods and services to change hands in a way where the market finds the right price as quickly as possible, right? And when you have that, it's more efficient, and it just leads to a whole ton of good things economically. And when we think about, investing in like a Vanguard index fund, for example, I love index. We have a slight variation of that we are proponents of here that I think is an improvement on that. I'll save that conversation for another day. But the argument for index investing is I'm not going to try to spend all this time picking the winners and avoiding the dogs. I'm just going to buy all of it and minimize my expenses because it's more efficient to do that. And these two things are not completely congruent, but they're pretty damn close. And I mean, there is just so much historical precedent for just let the market figure it out and don't intervene more than you really need to. And I'm going to sound kind of libertarian here by saying that. But obviously, roads, defense, you mentioned, we all need social services and all that. But allowing the markets to figure things out on our behalf generally leads to the best outcome.
Absolutely. And I think your example of index funds, I'm not going to be able to say it better than you just said it. But as an economist, I mean, yeah, an index fund, you're betting on the success of capitalism. Essentially, you're betting on 300 years of markets deciding efficiency, and that's why I love them. It just makes sense. And then you combine it with like a Vanguard product or a product that really lowers that barrier to entry or lowers those fees. You couple that with a good strategic plan. I always say this. I'm like, I don't know how much I would just say the average person should just go invest on their own. If you don't have time to invest on your own, which none of us do. Like I don't, I certainly don't. The benefit of knowing how to not just move the funds properly into the index fund and time and dollar weight average and all that stuff, but combining that with what you just described, that holistic approach, I think that's just very beneficial to anybody who's trying to invest. I think it's almost like you need a guide. Never go it alone. You definitely need a guide. I'll say that.
Yeah, I mean, I feel like you just want to let the markets do the work for you. And the more that you interfere with that, the more that you're getting in the way of this beautiful system that will compound to your benefit if you let it. And setting it up the right way in the first place is just vitally important. But rather than having this episode be just a commercial for our services, what I would rather do is talk about the national debt, because we're up to, I think, $33 trillion. We run really big deficits every year. Seems like neither political party is terribly interested in cutting into that, even though one party will claim that they are. Interest rates are up. And I can't remember the exact stats, but a large portion of that $33 trillion is actually going to roll over here at some point in the next 12 months at higher rates, which makes it a lot more expensive to service for the country. So at this point, last time I checked, we're at about 120% debt to GDP, meaning that our total national debt is about 120% of all the goods and services that we produce as a country every year. I'm curious what your perspective is on this. Is this a dangerous level? Where do we go from here? What is your level of concern? What's your take?
So national debt used to always freak me out. It always freaked me out. Like I would say probably like I'm a nerd. I knew I wanted to be an economist when I was like 14. Like I direct admit all that stuff. I love being like it is literally my favorite field, which is horrible. No kid should want to be an economist. You definitely shouldn't. Like definitely not normal. God love my parents for dealing with me. It used to freak me out when I was younger. I definitely would say it's one of those things I hear people are concerned about it, because one of the things I hate doing as an economist is tell people not to wear. I don't like that. I don't think that's a good thing to do as an economist. It's just, oh, don't worry. And they give some horribly Socratic answer, leaving that person to go like, oh, well, I'm never going to talk to this person again. I never want to hear from another economist. I want people not to want to hear from me again for substantial reasons, not just passing comments. But it used to concern me. And so I went through kind of a compulsive phase of really trying to understand the national debt. Well, what is now? National debt's so fascinating. National debt concerns me in every country besides the United States. That sounds weird. People are like, well, what do you mean? Oh, but because you're biased. Well, yeah, obviously I'm biased towards the U.S. But it's because it's an unfair game. If you were going to build an equitable system of debt, it would not look like what the world does today. The table is stacked too heavy in the U.S.'s favor. Now, to kind of expand on that, as we know, the global economy trades in the U.S. dollar. The U.S. does about 60% of all trade in U.S. Sorry, the economy does about 60% of all trades in U.S. dollar. But what's more important to note is that about 80 to 85% of all global trade involves currencies that are either U.S. dollars or they're denominated by U.S. dollars, or their central bank holds majority U.S. dollars. Like you can't escape it. When I was giving that presentation a couple
of and by the way, for our listeners, sorry to interject, that's of all the aggregate transactions on Earth.
Yeah.
Every single financial transaction, you add it up, 60% of those transactions are directly in U.S. dollars. Another 25% are in currencies whose central banks have loads and loads and loads of U.S. dollars. And for all intents and purposes, that currency is de facto backed by the U.S. dollar as well.
Yeah. And then that country's gold's held in New York City, which is that another layer. When I was giving this presentation last month at this year-end conference, I had a fake chart come up. I don't like fake charts, but I had this fake chart, and I showed the Chinese yuan and the U.S. dollar, and I was explaining. I had the two bars right beside each other. It's a competition. I go, oh wait, I'm sorry, that's the wrong chart, and you can't even see the yuan. The Chinese yuan is like 1% of the market, and it's only forced upon like poor developing nations that are forced to use it. It's
Belt and Road.
Yeah, right. Belt and Road, but which is turning out just horrible. Who would have guessed that a country that couldn't strategically build long-term infrastructure also can't build strategic long-term infrastructure in other countries? I would have never guessed that. And so I show that. I go, there's this misnomer in the media that China's catching up to us, and that the yuan the red back is going to take over. And it's like, it's not. It's a manipulated currency, so it's never going to be used for trade. But when we look at the U.S. debt, one of the reasons I'm not as concerned is that one of the big ones is the biggest owner of U.S. debt is U.S. citizens. The second biggest owner is I would argue, probably our biggest ally in the world, or at least our most devoted ally, which is Japan. And then China holds about 20% of it. And people say to me, they go, Eric, doesn't that consider Chinese holds 20% of our debt? So I always explain it. This is the way I like to look at it. What is debt? Debt is the obligation for a future payment, and you get a little piece of paper. What did you trade that debt for? Capital. A lot of times it's capital. So what's more productive? A car or the note on a car? It's the car. The car is the capital that moves. So if you give somebody a bunch of pieces of paper and they give you a bunch of capital, that capital is what creates production, right? Capital and labor that's a production function. Now, that's usually fair, right? Because you can't print your own money to pay the bank back. And the bank has this legal enforcement, all right? But what if you could print money to pay the bank back? What if you bought your house and when you went downstairs, you had a machine that just printed the pieces of paper that a bank would take? That's kind of unfair for the bank, right? You get the means of production, you get the stuff to work, and you can just pay me back in, what's that again? The thing that you produce? Yeah, that's That's the U.S. trade. That's the U.S. That's the national debt. Oh, and by the way, even if you paid your house off using a money printing machine you had, you would at least hurt yourself by causing inflation. If the U.S. just handed China $6 trillion, that probably wouldn't. It would probably affect the U.S. from an export standpoint, but it would disproportionately affect China. It would disproportionately affect whatever nation we're paying off. But what the national debt represents in a lot of cases, and what we're having the government shutdown talk right now about it, is more about the U.S. refusal to practice seigniorage, which is when you print money to pay your bills. We don't do that. You can do that. That's called an inflation tax. You print money, and then the money becomes less worth. It becomes less valuable, and then you take it out of the economy. But when the national debt's growing, it's the U.S. actually, whether or not you think it should grow by that much, it's being fiscally responsible in the sense that it's borrowing the money it's spending. It's not just turning on the print. I always get upset when people say the U.S. is printing more money to pay its bills. I'm like, no, it's not. That we don't practice seigniorage. And then to kind of cap that all off, the U.S. debt has grown pretty substantially over the last, let's say, 5 years, particularly during COVID. We haven't had a president in a while who seems to be interested in a balanced budget. But where you see that reflected is future interest rates, because people are betting on taxes going up to service that debt service. And so a municipality like Quincy, I sell about $200-300 million in debt a year. Our debt's tax free. We get insanely low interest rates. We get lower. We're 2.5% lower than comparable treasuries, which is wild because the U.S. Treasury is backed by the full faith of the U.S. government that makes the U.S. dollars. There should be no risk there, but they're going to have to tax more in the future, and their debt's taxable. So the biggest threat with high national debt is that it will drive up interest rates because people know that taxes are coming in the future, will either demand a higher rate of return, or they'll be more competitive for tax-free notes, which then will have higher premiums and kind of lower that efficiency gain there. But no, I think if it was any other country, if it's Japan, which is practicing triple M right now, that they're about 340% national debt combined with an aging population. The U.S. doesn't have a decline. We're the only OECD nation that doesn't have a declining population because of immigration, which is super important. There's people showing up here to work. Other countries don't have that benefit. So the national debt by itself is terrifying. What is $33 trillion? What is that? It's an insane number. But if we go a step lower, we look at all these different metrics and what actually makes up the system, it makes me sleep a little better at night.
Yeah. So I think I agree with almost all of that.
Ooh, almost. Okay.
One thing that I want to explore a little bit more is when if there's an expectation that we are in debt and the load of debt is going to increase, the avenues to reduce the debt load almost never, ever, in fact, I don't think that historically they ever wind up resulting in higher taxation for countries like us. They wind up resulting in higher taxation in countries where your currency is pegged to another currency or it's backed by like a commodity like gold or silver. But my take on this is that the math is, so we've got $33 trillion in debt. If we're going to run a fiscal deficit this year to where we take in $1 trillion more or less in tax revenue than we're spending, right? So we're adding $1 trillion to that debt. Now we're adding $1 trillion to the debt. We have to pay interest on it. And the math is that the interest on that additional $1 trillion of debt is an additional cost. But if the $1 trillion that we borrowed to get there results in more than $1 trillion of GDP, right? If it results in more growth, then it's a good idea to go into debt. Okay. So as this thing escalates, as we add to the federal debt load, and our interest, the cost to service debt, goes up and up and up as a portion of our GDP, that becomes harder and harder for the U.S. government, or any government for that manner to maintain, right? The thing that I don't totally agree with you on is that when you're in that situation, I don't think that this is like an imminent threat either right now. Let's say, for example, that we have real problems. Let's say that interest rates, for whatever reason, go up to like 20%. And we have to refinance all this debt, and we simply can't afford it at the federal government's level. There are several options that politicians have to get us out of that hole. One of them is they can put some kind of policy through that stokes economic activity. Because if you keep the exact same tax rates and you push more stuff, more GDP through the system at the existing tax rate, it creates more revenue. And that's common. That's like the first line of defense. That's what every politician wants to do because it's easy to get reelected. It's easy to push through, right? One other thing that you can do is print money. And this isn't necessarily by running the printing press to pay for existing expensive. What was the term that you used for that?
Seniorage.
Seniorage.
Yeah.
I've never heard that term. That's interesting.
That's one of those weird terms you'll stumble upon, like if you go down the rabbit hole.
What we have seen recently is monetization of debt, the addition of debt being added to the Federal Reserve balance sheet in exchange for money being sent into the system. Right? So that's another thing that we can do. We can print our own money. We can simply spend less money to balance the budget, right? If we can not run federal deficits without changing the tax level. Politicians don't really like to do that because austerity is hard.
Yeah.
You're likely to not get reelected. You're probably going to piss a lot of people off when you do that. So historically, when countries have been in this situation, that hardly ever winds up happening. Austerity measures are put in place by other countries who you owe money to, right? This happened to Greece in the Eurozone 10 years ago or so. Didn't work out well for them either. And then the last thing that you can do is you can obviously raise taxes. But raising taxes is just hard to do politically. And I'm paraphrasing Ray Dalio's work. Have you read his book on this?
Yeah.
Yeah?
Yeah.
That was the most cogent explanation of this that I've ever run across. And it just makes too much sense not to be. If you look over like the last 500 years, of those four options, politicians always want to improve economic throughput, number one. There's no downside to that. And then print money secondarily to that. But they don't want to go through austerity measures, and they don't want to raise taxes. So the point that I'm not totally in agreement with you on here is I don't know that our debt position today and over the next 25 years is going to result in drastically higher taxes 10, 25 years from now. Granted, they're at a low level than they've been in a very long time for us as a country, but I'm curious what your thoughts are on that point.
Yeah, this is first off, this is great. This is a great conversation, and I will tell you, I think a lot of people like you, Grant, who are very financially and economically savvy. This is actually not the first time that I've had that counterpoint, and I gotta be honest with you, I respect it a lot because I'm somebody who's required to have a balanced budget. I have to have a balance. I just passed my tax rate 2 weeks ago. The state of Massachusetts has to have a balanced budget. The only people who aren't allowed to have a balanced budget is the largest budget in the world. Like, if the U.S. government, just the U.S. government, was a country,
if you can borrow at 2.5% below treasuries, dude, you should load that budget up. Why not?
Like, if the U.S. was just like the U.S. government was just its own country, it'd be like the fourth largest, fifth largest economy on earth. I was talking to my class. I'm like, you could take the Russian pre-war GDP and the Ukrainian pre-war GDP, and you would still have money to pay all Social Security and national defense if the U.S. just was like, we'll pay all your, like, that's just how big it is. So I'm on board. And that's before COVID stimulus. Now I think we did third largest. So there's a couple parts of that. Your comment on FOMC, like Federal Open Market Committee, being able to use balance sheet positions from the Federal Reserve to generate debt. That is a fascinating discussion. This is something that you would be at like the forefront of institutional economics if you dove in there with how this is thought of. Traditional economics would say, no, that's not debt. It functions like debt. It's debt. It's like you're buying bonds.
You owe the money back, right? So
cash goes out into the economy. And the logic was always, well, as long as the federal balance sheet is higher than the outstanding bonds that it's buying and selling on the FOMC, no new debt is created. Maybe that to me, I mentioned that ivory tower like answer. That's an ivory. Come on, that's an ivory tower answer right there. It feels like debt. It acts like debt. And in the short term, what does it do? It pushes liquidity into the market. There's nothing elastically says there's nothing new under the sun. Well, yeah, this is why Pep Banks, for the First National Bank, everybody got upset at that because it was basically winners and losers being picked for pushing government bonds out at different prices. It cost the U.S. The U.S. Treasury $14 to print $1 million. So like you can make money off that. I totally get it. So yes, I do agree with that point. I would say in the long run, over let's say 20, 30 years, I'm not sure I'm convinced how effective that is. There's a movement in macroeconomics where they reject the idea of long run aggregate supply, which is another name for GDP, that it's really just a bunch of short run aggregate supplies. And I think I think your narrative right there is spot on to that thought process, that these guys are making decisions, these guys and girls are making decisions today. And the guy tomorrow is going to be making a decision today, and the guy after him today. They're not making 50-year decisions. I will say I do very much agree with that. The question on taxation. Now, as long as your GDP is growing, and you said this far better than I, your GDP is growing faster than your national debt's growing as a percentage, you're really not in any bad area, because you can create further taxation, you can create more. Who doesn't like more? It makes me happy. My national politicians are running around stimulating economic growth for the purpose of getting higher tax revenue. Great. I want more economic growth too. The U.S. is in a very peculiar position for a developed economy. We have a very low marginal propensity of taxation. And it basically means that there is more tax dollars that can be generated from U.S. businesses and U.S. individuals than compared to the other developed economies in the world that we see in Southeast Asia and we see in Western Europe, by a huge magnitude. The U.S. is very weird. We have crazy high income. We have crazy high per capita capital behind each worker. And we have relatively weak taxation. So what does all that mean? Well, it means that if you ever have to draw the tax revenue, and which is a little bit of I'll say I don't want to say I'll change my answer up a little bit. I'll specify my answer a little bit more. If you're concerned about the national debt, is if we're not going to be able to pay it back, there's multiple avenues that will allow us to pay it back. And if you have to go to the worst one, which is just taxing people, there's an ability to tax people without hurting GDP growth, which I'm sure somebody will not like hearing me say that, but just from a purely mathematical standpoint, the marginal propensity of taxation is low enough in the United States that it's not a threat to tax people more to pay off debt. Will they do that? I don't know. Show me one politician you ever heard wants to raise taxes. And I'll show you an unelected person. So this is where I always say finance and economics are sister fields. They're two sides of the same coin. And I think whenever I think it's unfair. There's public policy is public economics. In public economics is this great policy discussion. And as somebody who works in public finance, we don't get to have that fun. It's not the same thing. It's not this great discussion of saying how do financial policies affect decision making? And I gotta say, Grant, I do agree with you on that point. I don't think, while it's a tool they don't reach for, because nobody wants austerity. No, nobody wants that. And if you can continue to push growth and you can continue to use FOMC to stimulate the market, is there a reason to pass a crazy high tax bill and not be elected next year? I don't know. Human nature is
exactly
right.
Exactly. Nobody's going to make that decision.
Yeah.
Well, that's interesting. I could talk about this stuff all day, Eric. This has been an awesome conversation, but I know that we're toward the end of your day and need to wrap things up pretty quickly. We have this long list of stuff that we didn't even get to, like the employment market, bank health, commercial real estate. I hope you'll be willing and interested in coming back on the show sometime to talk about some of these other topics. It's been a really fun conversation.
Absolutely, and I do apologize for maybe derailing it a little bit, but it's great being on, and it's I look forward to continuing to follow you and your great work, and I think I'm always open to a discussion in the future.
Oh, thanks. This is I've really enjoyed it. I really appreciate your perspective and the work that you put into your local office and community. Must be a good spot.
Love it.
Tell everybody about your website.
Yeah, absolutely.
Where can people find you?
if you want to follow me and see some other conversation I've had with many great people like Grant, you can, my website's theinformaleconomist.com, and you can also follow me on LinkedIn. I post about a lot of these topics. I try to be less ranty, but as sometimes you can have a really good discussion on them. But yeah, follow me or check out my website. I'm trying to keep it up to date.
I don't think you were ranty at all. I think it was very objective, open mind. That's precisely what we try to do on the show. Well, thanks, Eric, for the time and the discussion. I really did enjoy it, and look forward to catching you again soon.
Thank you, Grant. Have a good one, sir.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.